Most people look at a stock chart and focus on one thing, the number moving up or down. That moment often happens late at night or early in the morning when someone checks the market and sees their savings rise one day and fall the next. The reaction is usually predictable. When the number climbs, excitement appears. When it drops, frustration quickly follows. Over time, this emotional cycle quietly shapes how many people approach investing. Yet, something interesting happens when you observe experienced investors in the United States. They look at the same chart and see something very different. The price still matters, but it is rarely the starting point of their thinking. Instead, they begin by asking a deeper question that most people never consider. What system is actually producing that price movement? Understanding that system changes how every investment decision is made. The market is not simply a place where prices move up and down. It is a complex environment where millions of decisions interact every second. Large institutions allocate capital across industries, companies raise resources to expand operations, long-term asset managers study economic productivity, and everyday individuals participate alongside them. Every trade represents a decision shaped by information, expectations, and long-term planning. When someone truly understands this structure, the market begins to resemble a giant information network rather than a random collection of numbers. Within that network, capital gradually moves toward businesses that produce real economic value. Smart investors recognize something that many participants overlook. Price movements alone rarely explain what is happening in the economy. A rising price can attract attention quickly, yet a higher price does not automatically mean something is becoming more valuable. At the same time, a falling price can create concern even when the underlying business continues operating normally. This difference exists because price reflects collective behavior in the moment. Millions of participants react to headlines, expectations, and emotion. Value develops differently. It grows through productivity, innovation, and consistent economic activity that unfolds over long periods of time. In practical terms, this means a company that builds useful products, improves services, and expands its customer base may quietly increase its economic value long before the market fully reflects that progress. Instead of reacting emotionally to every movement on a chart, smart investors spend much more time studying how businesses create real economic output. They observe how industries evolve, how companies solve practical problems, and how long-term economic trends influence demand. This process often involves studying systems rather than chasing signals. A signal might appear on a chart for a few minutes or hours, but a productive system can operate for decades. By focusing on systems, investors begin to recognize patterns of productivity that extend far beyond daily price movements. Once someone begins observing the market through this lens, a surprising realization appears. Many of the most important economic changes happen quietly long before they become visible in headlines. Another important way smart investors think about the market involves probability. Many beginners search for certainty. They look for someone who can explain exactly what will happen next week or next month. Yet the market rarely moves in a straight and predictable direction. Experienced investors therefore build decisions around ranges of possible outcomes rather than relying on a single expectation. Instead of asking whether something will definitely succeed, they examine whether the long-term probability supports participating in that opportunity. This approach allows them to make decisions that remain stable across different scenarios, rather than depending on perfect predictions. Smart investors also understand the powerful role time plays inside the market system. Financial growth rarely arrives through a single dramatic event. Instead, it develops gradually through a series of steady improvements that build on each other year after year. Businesses expand operations, improve technology, increase efficiency, and reach new customers. Each improvement may appear small on its own. Over time, however, these developments compound into significant economic value. When investors begin viewing the market through this long-term lens, daily volatility becomes far less distracting. temporary fluctuations still occur, but they begin to look like short-term adjustments rather than signals requiring immediate action. Another important characteristic of smart investors is their ability to filter information. Modern financial media operates in an environment designed to capture attention quickly. Headlines frequently highlight dramatic market movements, sudden rallies, and unexpected announcements. These events can dominate discussion for several days, yet many of them have limited influence on the long-term direction of the economy. Disciplined investors separate information into two categories. One category includes short-term developments that generate attention but rarely change long-term productivity. The other category includes structural developments that reshape how industries operate. Technology shifts, demographic changes, productivity improvements, and evolving consumer behavior belong to this second category. Another mental framework used by experienced investors involves understanding human psychology. Markets respond not only to numbers, but also to collective emotion. When optimism spreads widely, prices can climb rapidly as participants compete to participate in perceived opportunities. When concern spreads across the system, prices may fall even while businesses continue operating normally. Smart investors recognize these emotional patterns and observe them carefully. They understand that emotional cycles influence the entire market environment. Remaining calm while others react emotionally often becomes one of the most valuable psychological advantages in investing. Financial markets move through cycles of excitement, concern, recovery, and expansion. Each phase influences how participants behave. Those who understand these cycles maintain a stable strategy, while others repeatedly change direction based on temporary conditions. Experienced investors also accept another reality that many people struggle with. No one can understand every opportunity in the market. The global economy contains thousands of industries and millions of businesses, and attempting to follow everything quickly leads to confusion. Disciplined investors narrow their focus to areas they can realistically understand. They study business models, customer demand, and long-term economic drivers within those specific sectors. Finally, smart investors think about the market as a long-term partnership with productive businesses. Every share of a company represents partial ownership of real economic activity. Employees design products, engineers improve technology, logistics systems deliver goods, and customers purchase services that support daily life. Viewing the market through this ownership lens transforms the entire investing process. Decisions become grounded in economic productivity rather than short-term price reactions. Understanding these mental frameworks is the first step toward thinking about the market the way experienced investors do. Yet these principles represent only part of the picture. To fully understand how disciplined investors operate, it becomes necessary to examine the deeper decision structures they use when evaluating opportunities, managing uncertainty, and building long-term financial resilience. That deeper perspective reveals why some investors remain consistent through decades of market cycles while others struggle to maintain stability. Understanding how smart investors think about the market requires going beyond basic financial knowledge and examining the decision structures that guide their behavior over long periods of time. These structures are rarely complicated formulas or secret trading signals. Instead, they are mental frameworks developed through years of observing how markets respond to innovation, productivity, and changing economic conditions. Many new investors expect successful market participants to rely on complex predictions. In reality, experienced investors usually rely on a much simpler process. They learn how the economic system evolves and then align their decisions with those long-term patterns. One of the most important frameworks involves separating activity from progress. Financial markets are extremely active environments. Prices move constantly. Headlines appear every hour, and analysts release new opinions every day. This continuous stream of information creates the impression that meaningful progress must also occur at the same speed. Yet the real economy moves very differently. Businesses develop products over several years. Infrastructure expands gradually. Technological breakthroughs often require long development cycles before they become widely adopted. Genuine economic progress usually unfolds slowly, even while market activity appears fast and dramatic. Smart investors avoid confusing visible activity with real advancement. Instead of focusing on the constant movement of prices, they observe where productivity is improving within industries. Another powerful framework involves understanding scale. Many investors begin their analysis by examining small details within a company or reacting to a short-term event affecting a particular sector. Experienced investors often step back and ask how large the underlying opportunity actually is. A company solving a narrow problem inside a limited market may still operate successfully, yet its long-term growth potential remains naturally restricted. By contrast, a company addressing a widespread challenge affecting millions of people operates within a much larger economic environment. Scale determines the size of the opportunity and helps investors understand how much economic value could realistically develop over time. Another framework used by experienced investors focuses on resilience. Markets naturally move through cycles of expansion and contraction. During strong economic periods, demand rises across many sectors. During more difficult periods, demand may slow and companies must adapt. Investors therefore examine how resilient a business model is under changing economic environments. Businesses that provide essential services, maintain disciplined operations, and adapt to evolving customer needs often demonstrate stronger resilience. Resilience allows productive enterprises to continue generating value even when economic conditions change. Another important structure involves understanding incentives. Every organization within the market operates according to incentives that guide behavior. Leadership teams pursue strategies designed to expand their companies. Employees focus on productivity and innovation. Consumers choose products that deliver practical value in everyday life. When incentives encourage long-term value creation, organizations often develop strong foundations. When incentives reward short-term decisions without considering durability, long-term stability can weaken. Information discipline also plays an important role in how experienced investors think. Modern financial markets generate enormous volumes of data. Economic reports, corporate announcements, technology developments, and global trade trends create a constant flow of information. Smart investors therefore develop systems for filtering information. Structural developments such as advances in computing technology, improvements in medical innovation, or major transportation breakthroughs can reshape entire industries over many years. Short-term headlines often create excitement but rarely change long-term productivity. Another dimension of smart investor thinking involves understanding competition. Markets reward businesses that consistently improve how they serve customers. Improvements may appear in stronger efficiency, better product design, reliable service, or stronger distribution networks. Competitive advantages usually develop gradually through continuous improvement. Investors who observe these dynamics gain insight into which companies are strengthening their position inside an industry. Uncertainty also plays an important role in financial markets. Many people feel uncomfortable when outcomes cannot be predicted precisely. As a result, they delay decisions while waiting for complete clarity. Markets rarely provide that level of certainty. Smart investors accept uncertainty as a natural feature of economic systems. Instead of eliminating uncertainty, they design decisions that remain stable across many possible outcomes. History also provides valuable perspective. Financial markets have existed for centuries, and historical patterns reveal how economies respond to technological revolutions, demographic changes, and productivity shifts. Entire industries have emerged from innovation, while others gradually declined as new solutions replaced older systems. Studying these transitions helps investors understand how economic transformation unfolds over time. Another important framework involves interpreting market volatility. Price fluctuations often trigger emotional reactions, yet volatility frequently reflects the process of new information entering the market. Economic reports, technological developments, and global events continuously update expectations about future productivity. Prices adjust as participants process that information. Thinking like an owner further strengthens the investment process. When investors acquire shares of a company, they obtain partial ownership in a business producing goods or services within the economy. This perspective encourages deeper analysis of operations, customer demand, technology development, and management decisions. Ownership thinking connects investing decisions to real economic activity. Finally, experienced investors recognize the importance of intellectual humility. Financial markets contain enormous complexity. Technologies evolve, global economic relationships change, and industries transform in unexpected ways. Maintaining humility encourages continuous learning and prevents overconfidence. Over long periods of time, markets reward discipline. Discipline involves maintaining a structured process for evaluating opportunities, managing exposure to uncertainty, and focusing attention on productive economic activity. Understanding how smart investors think about the market ultimately reveals an important truth. The market is not merely a place where prices move on a screen. It reflects how the economy evolves through innovation, problem-solving, and productive enterprise. Those who learn to observe the market through this broader perspective gain something far more valuable than short-term signals. They gain the ability to participate thoughtfully in the long-term development of the economy itself, building wealth that reflects real economic value created through productivity and innovation.